Hello, welcome to the capital asset pricing model. First, we're going to be going over the mean variance optimization and efficient frontier. Second, we're going to be discussing the risk-free rate and the US Treasury Department. Third, Tobin separation theorem. And finally, William Sharpe's CAPM, or capital asset pricing model. So here's a review of the mean variance optimization. So diversification reduces risk, right? That's our free lunch. By combining gold and Microsoft, we can reduce the risk of holding just Microsoft stock because they're uncorrelated assets. And the objective is to minimize variance and maximize return. And then finally, we could construct a portfolio that gives the optimal combinations of risk and return, which is the efficient frontier. We see that blue line basically being that, right? So we've got different combinations of risk and return. So I'm going to be introducing the risk-free rate into the portfolio first, right, before we go on to talk about Tobin separation theorem. So earlier we saw that the mean variance optimization, and it's dealing with two assets, a security issuance and a commodity, which was gold, right? So that's what we saw. Tobin introduces a risk-free rate and incorporates it into the portfolio of risk on assets. So before we discuss Tobin's theorem, let's first discuss what a risk-free rate is and where it comes from. So this is the US Treasury Department in Washington, D.C. People that have come to D.C. have stopped by. I know my sister-in-law who works in the financial services industry has stopped by and sees it almost as one of the great sites in DC. But what's the role of the US Department of the Treasury? The US Treasury manages the federal government's finances. A more accurate description would be funding government spending that exceeds tax revenues. To do this, it issues debt securities. First is Treasury bills, which is short term, a few weeks to a year. Treasury notes, medium term, 2 to 10 years. Treasury bond, long term, 20 to 30 years, right? When investors buy these, they're essentially lending money to the US government, which promises to pay interest and repay principal. I'd like to make a note that when you invest with these bills and you compare it to basically long-term investments, you'd want to have it relate to the time horizon that you're interested in. So if you're investing in Microsoft stock, you would want to, and you're planning to do it for a year or 2 years, what's the return on that Microsoft stock compared to a Treasury bill, right? If you're investing for 20 or 30 years, what's the rate of return on Microsoft stock compared to the Treasury bond? So these are benchmarks to compare it against other types of securities. So here's an example of a Treasury bill. It's $100,000. That's the face value. That's basically what's paid at maturity. Okay, and then you see on the left-hand side, 5.125% Treasury bond. Okay, and that's for 2022 to 2032. So it's a 10-year bond or bill. So I'm now going to be talking about Treasury bills and how that relates to our risk-free rate. So the definition of a risk-free asset has no default risk. 2, it has a known return, right? And 3, it's highly liquid and easy to trade. And that is all characteristic of a Treasury bill. So US Treasury securities can be used as the proxy. And then the US government is considered virtually default free, backed by taxation power and dollar printing. So the Federal Reserve could print as much money as they want, right? Technically, the US government cannot go into default. So let's go back to Tobin. James Tobin extended Markowitz's portfolio theory by adding the risk-free rate. This is called Tobin separation theorem. All investors should hold a combination of the risk-free asset and the same optimal risky portfolio, the tangency portfolio, regardless of their risk preferences. He created the idea of the tangency portfolio that maximizes the Sharpe ratio, which is this. Okay, so we're maximizing the weights, right, with respect to some type of Sharpe ratio, which is the expected return of the portfolio minus the risk-free rate, which is our treasury bill, and then the sigma of the portfolio, the standard deviation of the portfolio. Now we've got the expected return of a combination of assets. We use the risk-free rate, the expected return of a portfolio minus the risk-free rate, divided by the standard deviation of the portfolio, and then the standard deviation of the combination. Okay, so RC and sigma C are just the return and risk of the custom mix each investor chooses. Okay, the slope is the Sharpe ratio, right, which we just saw. And then the capital market line is a straight line that starts at the risk-free rate, which is the intercept, right, 0 RF, and goes through the tangency portfolio, sigma P, expected value of return P portfolio. So this is the capital market line, the red line, which I just talked about. This is the efficient frontier. We've got the minimum variance, and then we've got the tangency portfolio. Okay. So this is going to give us some type of rules for financing decisions. Each investor adjusts how much of their wealth goes into the risk-free asset versus the tangency portfolio, depending on their personal risk tolerance. Now, I've discussed in earlier videos kind of the decisions that different generations might make, right? Millennials might be more risk tolerant than Gen X. Millennials might be more risk tolerant than boomers, right? Boomers are going to be probably the most risk averse, right? So conservative investors would more weight in risk-free assets, right? Their portfolio is probably going to consist more of treasury bonds, right? Aggressive investors would borrow at the risk-free rate, leverage to buy more of the tangency portfolio, which is the optimal portfolio if we're mixing bonds and treasury bonds and risk-on assets. So the tangency portfolio is superior to the minimum variance portfolio, right? The MVP minimizes risk without respect to return, right? So we're just concerned in a minimum variance portfolio minimizing risk. The tangency portfolio maximizes return per unit of risk, which is what investors care about when a risk-free asset is available. So capital asset pricing models improves on Tobin. Tobin investors mix risk-free assets and a tangency portfolio of risky assets. CAPM insight is if everyone holds a tangency portfolio, it must be the market portfolio, all risky assets value weighted. Okay, we've got this formula for the CAPM, which is the expected return of an individual asset, is equal to the risk-free rate plus the beta of the individual asset times the expected value of the market return minus the risk-free rate. And the beta is the covariance, right, of the risk of the individual asset and the market return, right? And then that's divided by the variance of the market return. And this beta, basically, there's some heuristics that arise from it. The stock is more volatile than the market. That's high risk, high return potential. And then beta is less than 1. Stock is less volatile than the market. It's lower risk and lower expected return. So now I talked about basically the market, but what is the market? In most cases, in most cases, it's the S&P 500. Okay, so we've got all these individual securities basically built into an index, and we would consider that the return on the market. Now, the return on the market historically has done really well. Um, Investors like Warren Buffett have stated that if you're not good at stock picking, it's just better to buy an index fund and track that, right? So what's the CAPM logic? Let's go over that. So we have the risk-free rate, an example of 3%, expected S&P 500 return of 10%, a stock beta of 1.5. So recall that we have to add the risk-free rate plus the beta times the market return minus the risk-free rate. Okay, and if we do that, get some algebra, we get 13.5%. So investors can expect to be compensated by 13.5% by taking on risk that is 1.5 times higher than the market, right? So I talked about earlier, basically, if the beta is greater than 1, you're taking on more risk, but you're also probably going to make a greater return, right? When beta is equal to 1, that is the market, okay? So now we're going to talk about two stocks in comparison. We've got Microsoft. It's a technology company, as you all know. I mean, obviously, this has been around for a while, right? So you could consider it an old economy stock. And we can look at some of their financials here, right? We got the dividend, the PE ratio, 52 week, 52 week. I'm interested in the beta, right? So what's the beta? We see it's close to 1, right? The beta is close to 1, and it moves basically with the market, right? Here's another stock, Tesla. I mean, this is a lot more high flying, as you all know. And here's some stats on Tesla. Got a PE ratio of 209, which is considerably higher, right? EPS, earnings per share, 173. But again, I'm interested in the beta. Let's look at. And the beta is 2.06, okay, which is, it moves considerably. It's more volatile than Microsoft by a factor of 200%. Okay. So that's it for now. Thank you very much, and have a good one.